Good morning, everyone, and hopefully you can all hear me legibly. For those of you who I have not yet met, my name is David O'Reilly, and I'm the London Director for the British Irish Chamber of Commerce. I'd like to extend a massive thanks and welcome also to our kind hosts this morning, our valued council members in London, Moore Kingston Smith, a leading professional services firm, who will be walking us through some of the latest changes and announcements in the new Chancellor's budget, which was announced a few days ago. We're joined this morning by the team from Moore Kingston Smith in London, uh, Darren and Claire and Takeshi. Thank you very much for hosting us. Darren it will be saying a few words about the firm and extending his own welcome and that of the firm before passing to Claire Roberts, who is going to give us a short presentation with some time for Q&A at the end on some of the latest updates and how that will impact individuals. Obviously, the Chamber, as you will be aware, if you're a member, if you're not already a member, you can join us. Obviously, you're very welcome to join us after today. The Chamber's mission is to champion the €100 billion a year trade between Ireland and the UK, which sustains over 700,000 jobs across the two islands. And I spearhead many of our key relationships on the UK side, including into firms like Moore Kingston Smith. So we hope today's session is informative, that you come away with some new insights, and it's a useful snapshot update post-budget. And obviously, Claire and the team will be delighted to follow up directly with you. If anyone wants to reach out to the team afterwards, contact me, or else we will also circulate the slides, and Claire's details will be in the slides. So that's probably enough for me to start things off. We are on a half-hour time slot. Darren, if you're on and with us, would you like to say a few words about the firm before we pass to Claire? Thanks very much.
Thank you, David. I don't think Darren's made it on yet. We're having some technical difficulties, so I'll let him do a proper intro to the firm after my presentation. But just a little bit about Moore Kingston Smith. We are a 100-year-old firm. We're in our 101st year now. We are a multidisciplinary practice firm based in London and the South East. My name's Claire Roberts. I'm a partner in the private client tax team, advise on all aspects of personal tax. So I'm just going to talk today and give you a rundown of some of the highlights from the autumn budget. Big budget, first budget from Labour in 14 years, 41 billion of tax increases. So really big budget, far too much to cover in 15 minutes, but I will give you the highlights in terms of the measures that will affect individuals. Oh, Darren's here, so maybe it's an opportune time for him to... You're good, Darren? No?
Hopefully, can you hear me?
Oh, we can, yes. So actually,
I had all sorts of problems logging in.
Can you hear us?
Yes, I can now.
Okay. So Darren, before I kick off, because I imagine we'll have quite a few questions at the end of this, do you want to give a brief intro on the firm?
Yes, absolutely. Thank you. Very good morning, everybody. I hope everyone has had fewer technology problems than I have had so far this morning. And thankfully, that's indicative, I think, as we were also due to have tube strikes. Anyway, a little bit about Moore Kingston Smith. So we are a London headquartered multidisciplinary practice. So our core is accounting, auditing and tax, but we have branched out into HR, cyber and all sorts of other services. Our headcount is about 1,200 strong in and around London, and we now also have a practice in Northern Ireland and also in Ireland, and so we're honoured to be active members in the British and Irish Chamber of Commerce, and sharing our commitment to fostering business relationships across Britain and Ireland. So hopefully we'll get a chance to meet in person at some point in the future. But in the meantime, I'm going to hand over to Claire, who will tell you all of the wonderful things that the UK government have decided to do with tax and spend that are relevant to hopefully all of you. So hopefully we can carry on the conversations in future British and Irish Chamber of Commerce events. Thank you.
Thank you, Darren. So let's kick off. As I said, I'm just going to cover the measures affecting individuals. because I understand that's more relevant to this audience. So income tax and capital gains tax. So in terms of income tax, it was a promise delivered. There have been no increases in income tax rates, not only for working people, which was a term which is yet to be defined, but for all individuals. And similarly, we are not seeing any changes in the income tax rates, the national insurance rates for employees and self-employed. So the current income tax allowances and thresholds, they have been frozen since 2021 under a policy by the Conservative government, and that will remain in place until April 2028. And I guess in what you could describe as perhaps the biggest giveaway in the budget is that it was announced that those thresholds will rise in line with inflation in April 2028. So good news for people from that date. You know, they'll start to get more money in their pockets. Coincidentally, it will be around election time. But clearly, you know, it doesn't give any immediate relief for taxpayers. So capital gains tax. So unless, well, you've been living under a rock for the last few months, you will know that an increase in CGT was widely expected, but the increase perhaps wasn't as high as many had feared. So the lower rate of capital gains tax, which applies to gains which fall within your basic rate band, that rate is increasing from 10 to 18%. And the higher rate of capital gains tax, which applies to higher rate taxpayers, additional rate taxpayers, that is increasing from 20 to 24%. And those rates apply from budget day, so transactions on or after the 30th of October. So those rates now are aligned with the rates that apply to disposals of residential property. Those rates haven't changed. So you know, less rates to worry about when you're considering disposal of assets in the UK. So rather unexpectedly, one change that we did see was changes to the rates that apply for disposals qualifying for business asset disposal relief. So that's a relief that applies essentially to a disposal of business assets or interests. So as it stands, disposals qualifying for that relief benefit from a 10% tax rate and up to a lifetime limit of 1 million. So that's 1 million allowance isn't changing, but what we are seeing is an increase in the tax rate to 14% from April 2025 and then to 18% from 2026. So there will be a planning opportunity here to the extent that you can accelerate sales or disposals to before the end of this tax year or next before the rates increased. And just very quickly to mention on carried interest, so this was something that we were expecting to see. This was one of Labour's, big sort of proposals that they would be bringing carried interest, well, potentially within line with income tax rates. But what we have seen instead is that both the rates of capital gains tax on carried interest will increase to 32% from the 6th of April 2025. And that from April 2026, there will be further reform to that regime. And the expectation is that those that carried interest will be brought within the income tax framework. So more on that to come over the next year or so. So non-DOMs, which might be slightly more relevant to this audience when we're considering Irish nationals living in the UK. So as it stands, UK tax residents that are not domiciled in the UK can claim what is called the remittance basis of taxation, which essentially means that they only pay UK tax on foreign income and gains that are remitted to the UK. That is being abolished from April 2025. That had already been announced, and what we are going to see is a new regime, foreign income gains regime, which will be based on UK tax residents. And essentially, that will provide 100% relief on foreign income and gains for new arrivals to the UK in their first 4 years of UK tax residence. And individuals will be eligible for that regime, provided they haven't been UK tax resident in any of the previous 10 consecutive tax years. Now, there will be 2 transitional arrangements available to non-DOMs as we gear up to this. So firstly, non-DOMs who have previously claimed the remittance basis, they'll be able to rebase all of their assets that they held in 2017 to the market value on the 5th of April 2017, which will effectively mean that they'll only be subject to capital gains tax on gains from that date. It was previously suggested that that date might be later, but 2017 is what they've settled on. Secondly, there will be a 3-year temporary repatriation facility that will be introduced, which will allow individuals to bring in previously untaxed foreign income and gains into the UK at a flat rate of 12% for the first 2 tax years from the 6th of April 2025 and 15% tax rate from the 6th of April 2027 for that final year. And that facility will also be extended to foreign income gains within trusts where distributions are being made to individuals. One thing to note with that is that the funds don't necessarily have to be remitted to the UK, provided that the funds have been designated for use under this facility, because what will happen is that you will designate an amount and pay the flat rate of tax on that designated amount. So it doesn't actually require you to determine the foreign income and gains in a mixed fund, for example. So you could have someone with an account which contains clean capital, foreign income, gains, and they could designate the whole value of that account and pay the flat rate of tax on that amount, and then bring that into the UK at any point in the future without a further charge. So slightly simpler rules in terms of how that will operate, but clearly it will, you need to consider this on a case-by-case basis for the individual concerned. And so I guess the biggest sort of concern for non-doms is this inheritance tax regime. So as it stands, if you're not domiciled in the UK, you are only taxed, liable to UK inheritance tax on your UK assets. That is changing as well from 6th of April 2025 to a residence-based regime. And if you have been long-term resident in the UK, which is defined as someone that's been in the UK for 10 out of the last 20 years, then you will be within the scope of UK inheritance tax for all your worldwide assets. And that will extend to any non-UK assets within a trust that you have settled. So as part of, once you've been long-term resident in the UK, you will also then be subject to UK inheritance tax for a period of time after leaving. Now, it was previously suggested that that would be 10 years. Quite naturally, everyone was up in arms about that long tail. So thankfully, the government have shortened that period of time. So now that if you have been resident less than 13 tax years and you leave the UK, you'll then remain in scope for 3 tax years. And then it will increase by 1 tax year for every additional year of residence. So, for example, if you've got someone that had been resident for 15 out of 20 years and then left the UK, they'll remain in scope for a further 5 years after leaving the UK. So, essentially, what this means is that you would need to leave the UK in your 9th year if you don't want to be caught by this rule. And so for overseas individuals, they are going to be brought within the scope of IHT far sooner than they currently are. But on the flip side, the good news is that UK domiciled individuals can actually lose their liability to UK inheritance tax once they've been outside the UK for 10 years, even if they remain, under general law, UK domiciled. Ireland is actually one of the few countries with which the UK has an inheritance tax treaty. So buried in the detail of the budget, it did say that the treaties will continue to operate as they do now, which is good news. So there will be some protection there, potentially some exemptions available for Irish nationals living in the UK under the treaty. That will continue as normal. So on the theme of inheritance tax, just to bear in mind, given that some non-doms may now be within the scope, The nil rate bands are, which are currently frozen and have been for almost 20 years, they will continue to be frozen. So that's 325,000 standard nil rate band and 175,000 residence nil rate bands. So effectively, most individuals can pass on up to 500,000 tax free. One of the announcements, which perhaps was no surprise, it was largely rumoured, and we did see it announced, was that unused pension funds will now be brought within the scope of inheritance tax from April 2027. This isn't new. This was something that was around pre-2015, but the government have gone back to this because essentially people were using pensions, well, so the government thinks, as vehicles to accumulate wealth and pass on that wealth, and they obviously want pensions to be used for retirement. So that is coming in from April 2027 rather. There is a technical consultation out on how this will operate. There's still a lot of detail which isn't clear in terms of potentially double charges to inheritance tax and income tax before the beneficiary receives the funds. So watch this space in terms of how that's going to operate. Another big change, which has received arguably probably the most attention in the press, is the restriction to agricultural property relief and business property relief, which essentially provide currently 100% relief on agricultural property and businesses. Now, from April 2026, that 100% relief will continue to apply, but only to the first 1 million of combined agricultural and business assets. And thereafter, the relief will be 50%, effectively giving it a 20% effective inheritance tax rate. Again, there isn't technical consultation out on this, but the 1 million allowance will apply to assets in the estate at death, lifetime transfers in the previous 7 years leading up to death, and transfers into trust in lifetime. So this a huge concern for family businesses, that particularly they're going to be passed down to the next generation, because they're going to have to pay inheritance tax without having realised any of the cash. So real concerns about having to break up family businesses to fund the tax. There is, as is currently, the current regime to pay inheritance tax by instalments where you haven't yet sold the property, which will be available. But with that instalment facility, there's late payment interest, which is now at a really high rate of 9%. So an expensive option for anyone that would be looking to do that. I've seen a lot of noise in the press about, the government potentially, well, there's a lot of pressure on them backtracking on this measure. So let's watch this space. We haven't yet got draft legislation, so it may be something that is watered down before the rules are due to be introduced. And then finally on inheritance tax, in all circumstances, the rate of business property relief that's going to apply to, well, shares not designated as listed on a stock exchange. So here we're talking about AIM shares. That rate of relief is being reduced to 50%. So effectively, a 20% inheritance tax rate will apply on all AIM shares. And then just quickly to mention on stamp duty land tax, so the higher rate for additional dwellings, so essentially someone buying a second property, that rate will increase, or has increased rather, to 5% from the 31st of October. And again, we've seen a 2% increase on the SDLT rate for companies, increasing from 15 to 17. So really quite expensive now if you're looking to buy second homes. And one thing, again, it didn't receive a lot of attention, but it was sort of hidden in the detail, is that the temporary uplifts for first-time buyers, they will be reversed, well, come to an end. So they will reduce to 300,000 and 500,000 respectively from 1st of April 2025 for first-time buyers. I'm conscious that I've rattled through that, so I was very conscious of time.
I like the house in your slides, Claire. I like the yellow and blue house there. That's
I can't say that was my artwork, but
not going to come cheap. That's not going to be cheap. I suspect that's Notting Hill. I mean, that is a fascinating spin through what has been. It has been quite an interesting few days. I've, lived in the UK for 20 years plus now, and it is one of the, the more sort of exciting budgets, to put it in parentheses, that I've seen. Quite a, sweeping number of changes. I mean, in terms of any opportunities and areas that our members could be thinking about, we're always looking for opportunities in the British Irish Chamber, and every tout is a silver lining. Like, was there anything that was in the budget that maybe didn't get enough positive press coverage, in terms of some things that weren't changed in a negative way, that were actually positive developments? I mean, a lot of the press and the buzz around it has been focusing in particular, the farming, the changes to some of the farm inheritance tax. I know that's a big issue for that sector, but also obviously we're very conscious of advising our members and steering our members to people like yourselves to find new opportunities and better ways of doing things and setting up their businesses. Is there anything you'd like to say about that, in terms of anything we could be focusing people's minds on that's on a more sunny note than some of the things which have attracted some of the negative coverage?
Well, I mean, the increase in CGT wasn't as high as expected. So I think, in terms of how people hold assets, they can continue to hold them personally without sort of having to think about restructuring or holding assets in companies, which we feared may be the way that a lot of this would go if we did see quite a high increase in capital gains tax rates. In terms of the inheritance tax changes, there will be more limited opportunities for planning, particularly with trusts, but we haven't seen any changes to the regime for potentially exempt transfers. So where an individual makes gifts to other people, their family, their children, provided they survive 7 years, that value will still fall out of their estate. So that is still hugely valuable exemption, and I suspect we'll see a lot more of lifetime giving now to move some of that value outside of the estate, particularly as these releases have been capped. So that was an area where it was suggested that we may see a lifetime tax on gifts, but given that that's still in play, and some of the other more valuable exemptions as well, such as gifting out of income, potentially quite a lucrative exemption that allows you to gift income without having to survive the 7 years. You can still make use of those to counteract some of these inheritance tax changes that are coming.
Wonderful. I can see a question, just keeping an eye on our time as well. I know we promised we'd do a hard stop at 9:30. Darren actually has a question on the implications for the non-dom regime being abolished for those in the UK and those coming to the UK. I know that's quite a large topic. We could be here for a few hours covering that one. But is there anything you'd like to say about that as we close, Claire, and wrap things up?
Sorry, what was the question? The implications? Oh, I've got it here. Well, for those already in the UK, clearly, well, their affairs will need to be reviewed in terms of how they hold their assets, particularly any individuals that hold their assets in structures. They will need to look at what this will look like going forward, which obviously we can help with that. But there will be opportunities to potentially bring a lot of that wealth into the UK at a relatively cheap rate. So, we'd have to look at this on a case-by-case basis, but there will be opportunities for some of these non-domiciled. For those coming to the UK, again, well, there's a lot of planning to potentially to do before the 6th of April 2025 in terms of perhaps maximising the amount of clean capital that they have outside the UK that they can use and bring in after that date. Very conscious of time.
It'll be a busy few weeks and months ahead. I'm sure,
No,
Claire.
indeed.
No, absolutely. Look, I mean, keeping an eye on the time as well, and we've played. I have to say, you have played an absolute blinder to cover that in such a short space of time. So, on behalf of everyone in the British Irish Chamber of Commerce London chapter and the team dialed in from Dublin as well, and some of our members, I can see we've got a nice mix of people dialed in from Ireland and the UK. So, it's
Good.
exactly what we wanted to achieve, and we've covered the key points. A very, very tricky budget, a lot of changes, a new regime in town for sure, and no mistake about that. So lots for us all to do to work together positively, and also we'll be delighted to share the slides if that's okay with you, Claire, with
Yes,
everyone.
of course.
Or
And I've just
sorry.
seen a couple more questions come in, so I'd be happy to follow up with those individuals after this. It's not a
Yeah,
problem.
absolutely. And people can find you on email, croberts@mks.co.uk, and you'll be
Yes.
on LinkedIn as well. Thanks so much for dialing in, everyone. Thanks, Takeshi and Darren as well, and the rest of the team in Moore Kingston Smith. I'm sorry we couldn't do this in person, but due to the planned tube strikes, we moved this into an online format. We will do an event in person in your beautiful offices in Apple Street in the heart of the city in the new year. Take care, everyone. Thanks for dialing in, and see you at the next British Irish Chamber event. Thanks
Thanks,
very much,
David. Thanks, everybody.
Thank you.
Thanks a lot.